It looks like the bull has finally run out of breath as stock markets around the world continue to trend downwards. Technology stocks, which led the market rally early in the year, are now leading the rout. Nasdaq's FANG stocks, Facebook, Amazon, Apple, Netflix and Alphabet, have all contracted by between 0.3% and 12.5% in value over the past month. Analysts say the contraction may not necessarily be a bad thing.
The downside momentum, which at first it appeared like it was only a tech correction, but now it really has included the cyclicals, it included markets globally, and include really all the markets are participating. And this kind of decline is the first time we've seen this kind of decline since the February-March sell-off. And before that, you really have to go back to the fourth quarter of 2018 to see this kind of sell-off. So until we see really extreme levels of pessimism, the kind of extreme oversold conditions that we saw in March, I think we need to recognize that this downtrend is going to continue.
And it doesn't look like the volatility is going to let up anytime soon, especially with the highly anticipated US presidential elections just around the corner.
Usually, the couple of months before the US presidential elections, indeed US equities do go through a period of increased volatility. So what that means is that for the investor, if you are investing for the longer haul, I think that's quite okay. Because at the end of the day, we are looking forward to an economic recovery from the pandemic. But for investors with a shorter-term time frame or who could be currently now overweighted or over-leveraged into equities, particularly in the US equities, I think things are going to be a lot more volatile. It's not for the faint-hearted.
With market sentiment already frayed by the ongoing COVID-19 pandemic, analysts are concerned about the result of an unclear winner in the US elections.
We think about volatility really as a measure of uncertainty, and there's no shortage of that right now, which is helping to drive the volatility higher. So what we need to also recognize is while the market does tend to rally after the election, there was one year in particular when that didn't happen, and that was back in 2000 when the U.S. election was followed by this sort of hanging chad question where the results of the election were not known until the end of the year, and during that time the market did very poorly because of the uncertainty lingered.
But despite the expected volatility, analysts are optimistic that the post-pandemic recovery is on track.
I think by and large, investors have got it right that things are turning around. The reopening is happening. The gradual recovery will come into play. And over the next 3 to 5 years, we should see growth resume to normal levels, moderate inflation levels coming back into play. And for Asia markets specifically, larger trends such as the weakening US dollar, a very strong economic rebound in China will bode well for the outlook here. I think what investors need to do is to balance their long-term goals versus volatility management in their portfolios to make sure that they can handle the turbulence over the near term.
All analysts agree that Asian equities will be one area that bears watching in the next few months.
For the Chinese stocks, we are particularly interested in the consumption sector because of the aim and the target of the Chinese government for the consumption as a percentage of GDP to reach 60%. So with slow de-link of the Chinese economy from the US, we are likely to see them pushing a lot more harder into the domestic consumption part. The other big part is Chinese technology. We are very optimistic on Chinese technology companies. Of course, with the recent start of the CSOP Hang Seng ETF, the China technology ETF, that's one good indication that the Chinese are certainly much into cultivating their own strength in the technology companies, and not just for onshore, not just for Chinese domestic consumption of the technology, but exporting the technology out to the rest of the world.
As for the Singapore stock market, analysts say that things may be looking up for the STI.
The sharp rebound that we've seen from late March was mostly driven by momentum and growth stocks. Now, as we know, the STI is mostly dominated by cyclical and value sectors, and therefore it has lagged the global equity recovery to date. However, I think we've seen over the last few weeks during the correction that we've seen a rotation in performance, and the gap in performance between growth and momentum, as opposed to value and cyclicals, have been closing, and I think that bodes well for the STI going forward, especially since the valuation of the STI in terms of price to earnings and price to book versus historical levels seem less demanding than its global peers on similar terms. And also the STI continues to provide a fairly healthy dividend yield for investors.
They also have the same advice for investors: diversify and stay invested for the long term. And that there are definitely sectors and assets that are worth looking at right now.
Gold's been one of the more consistent outperformers that's been trending higher, benefiting from the uncertainty, from the low interest rates, benefiting from currency concerns. So I would say some exposure to gold would be warranted. Bonds, there's no signs of interest rates going up, and until that happens, bonds warrant continued exposure. And in terms of equities, I'd be very careful right now until this current sell-off runs its course. So be careful about equities, stay with the defensive names, and don't take on too much risk until we get on the other side of this crisis.